Let's get going here. Welcome to the Q2 Fiducient Advisors update. You're stuck with Matt Rice and I, unfortunately. So our lawyers couldn't be here, but they asked us to show this slide. So we want to make sure we stop here for just a moment. But as I mentioned, you've got Matt Rice, our Chief Investment Officer, and myself, Brad Long, as a partner and research director overseeing our public markets. Today, we're going to be covering three things. First, we're going to do a quick review of Q2 and year to date, just basically where are we? You know, we're about halfway through the year, a little over, so let's take stock and figure out where we've come. Then we're going to dive into some of our economic outlook. We've got a lot of questions from clients on the sustainability of the recovery. Let's add in some letters. Is it V? Is it W? Is it a head fake? So Matt Rice is going to talk about that. We're going to take a bit of a detour onto inflation. We know that a lot of investors have asked about inflation, concerns around inflation and what it means to your portfolios. And then we're going to dive straight into our mid-year outlook, kind of an update from 2021, and then look at 2022 and beyond. So with that, we'll jump straight into markets. You know, first and foremost, you can see across the screen here, orienting the bars are year to date, the circles are quarter to date. So a lot of proverbial green on the screen here. On the left side, we have the dark blue as fixed income. You know, by and large, positive for the quarter across at least what's on the screen, but we do have some negative year to date numbers. I think many are aware rates have changed, which we'll get into in just a moment. But at least in the quarter, they had rallied, and anything with spread or yield had also done well. So we see a lot of positive returns in fixed income. Across risk assets, both real assets and equities, we do see a lot of positive returns both year to date and for the quarter. Interestingly enough, in the gray bars here, we do see for the quarter at least somewhat of a slowdown in the pandemic reemergence as we've exited, or entered kind of the Pfizer COVID era of vaccinations. It was really things that were left for dead previously had come roaring back. So that was small cap and value and financials and energy and real estate. That's still largely a trend today, but it has slowed a little bit. So you can see small caps underperforming large caps, international underperforming US. But across real assets, which is the light blue on the right, still obviously performing very well across the board, especially with US real estate jumping ahead, and we'll get more into that in a moment. Across fixed income in the upper left, this is really part of the component that's been driving fixed income for the quarter. So the bottom bar here, you can see that's a year ago, June 30th, where rates were. So the 30-year is at 165. As of March 30th, 2021, rates had risen to 242, but then have come in a little bit to 206 as of June 30th. Now, as we know, this is dynamic. Rates moved quite a bit yesterday. Markets were moving. All this data as of June 30. So we might and have received some questions relative to more recent, even in just July, but nonetheless for kind of year to date and halfway through the year, that's where we sit. In the upper right graph and in the bottom graph, these really both describe the components of return within fixed income. The two primary drivers of return over the quarter have really been rates, as I mentioned, rallying. So remember, interest rates are inversely related with price. So as interest rates come down, prices go up. Vice versa is also true. And then spread. So the amount of yield associated with a bond, if spreads decrease, that means prices are increasing and vice versa. Spreads did tighten both on investment grade and high yield bonds across the curve. They're now inside their long-term averages, but that has certainly added to fixed income returns. As we move into equity markets, as a quick update here, the upper left is a chart that we've been getting a lot of questions around, just current equity market valuations. Quick orientation, so the block in the middle, that's kind of one standard deviation of valuation, so price relative to earnings. So you can see the dots above it, the gray and the light blue. Those are 331, which is the darker blue. And sorry, I'm colorblind, so this is a bit of a fun exercise for me. And then the gray. The gray is the 630 marks for valuation for equity markets. And the blue is 331 marks. Now, interesting enough, prices in equity markets have gone up since 331 in 2021, but valuations have come in just a bit. The difference there is earnings. So remember, valuations are prices on the top of the ratio, earnings are on the bottom. Earnings have actually risen faster than prices have risen, and so that's benefited valuations. Now, valuations by pretty objective standards are fairly full. We know that valuations are also not a catalyst for market change. Just because things are rich doesn't mean they can't become more rich or pull back. Over the long term, they're very predictive, and over the short term, it's somewhat of a random walk. But it does have an inference on long-term opportunities within equity markets, and we'll get into that more as we talk about outlook with Matt Rice later. Upper right graph, just orienting ourselves with sectors. I don't want anyone to be confused by this graph. We do show IT, information technology, is the #1 contributor to the Russell 1000, or basically US large cap stocks. That is true, but also keep in mind technology accounts for nearly a third of the Russell 1000. So IT was up over the quarter, no question, but it wasn't the leading sector. It just happened to be one of the largest ones. The leader actually happened to be real estate. That reemergence trend continues, but it's only 3% of the index, so it didn't have as large a contribution as others. Bouncing down on the bottom graph, there is, we have gotten some questions around COVID, herd immunity, vaccination rates. Does that have an inference on the US versus international countries? Here we're displaying the top 10 countries around the globe and both their year-to-date and quarter-to-date returns. At this point, there is not a strong correlation between highly vaccinated countries and high returns, and conversely, low vaccinated countries and low returns. We'll see the jury's out on what the vaccination does with local, with the need for local shelter-in-place measures or others. But nonetheless, we can see across the board we have both positive price appreciation for the quarter and for year-to-date around the globe. Finally, just in the review here quickly, just on the real assets mark, many real assets, to be frank, were kind of left for dead if we're rewinding the clock a year or maybe even back to March of 2020. And clearly those have had a resurgence here. Energy leading the way, both for the quarter and year to date, pretty spectacular, 44%, year to date returns, not something that we would expect to be sustainable. If we rewind the clock, we do remember WTI trading at negative prices. So someone would pay you to take a barrel of oil. Clearly adverse times during the dog days of the pandemic, but that sector has rebounded quite a bit. The one exception you do see here on the screen in real assets is precious metals. Now, precious metals, this index is materially influenced by gold. Gold was a bit of a darling in 2020 and has been underwhelming in 2021. So that's been driving down the return there. And then on the right box, we do have kind of the subsector breakdown of real estate. Real estate is a really big, broad bucket. It's not just a homogeneous group. So the areas of leadership there really come from things like residential. So think of even urban residential, multifamily housing. As people look to maybe move out of a city or find a new place, you're spending more time at home. Kind of that whole trend. We have seen a lot of pickup there, and prices have appreciated. It's really coming through the earnings of those businesses, like multi-year contracts on rents, the ability to raise rents, et cetera. So that space has continued to rebound as we've come in through the year. So all of this is kind of a quick in review, but now we want to pivot and talk about some of the questions that we've been getting really around the economic basis for market prices and the potential expansion. Is it real? Is it a head fake? And how material is it? Kind of reconciling with our 2021 outlook. So I'll turn it over to Matt Rice and we'll go through some of the economic expansion. So Matt, over to you.
Thanks, Brad. It's we've been through a bit of a wild ride economically, and if we take a look really at the next slide here, we can illustrate that. The slide almost looks like a stock market chart, but this is GDP right here. So you can see at the beginning of the pandemic, if you look at the fourth quarter of 2019, which is kind of the peak from a GDP perspective, the economy shrank about 12% from peak to trough through the second quarter of 2020. And then what we've had since has been just torrid economic growth on the way up, kind of recouping a lot of what we lost. And so about close to a 15% uptrend. So if you kind of look at where we were in the fourth quarter, where we were in terms of the end of the first quarter, now back to pretty close to where we started, a little bit ahead of where we started from an economic perspective. So I think that's useful insight. I think a lot of us are conditioned to think about GDP in terms of quarterly annualized, but just looking at the numbers can put things into context a little bit better. So we move to the next slide here. This is what's called GDP Now. It's an estimate done by the Atlanta Fed, where real time they kind of feed it with data. I think it's important for people to remember that markets don't move based on changes in economic growth. They move based on changes in expectations around economic growth. So what the GDP Now does is it just, as time goes along, it just feeds in new data real time and allows the model to kind of simultaneously put in there kind of changes to the expectation of the second quarter GDP number, which hasn't been released yet. And what you can see generally here is over the last few weeks, you've seen the GDP Now, and you've seen even the economic forecast range kind of trend sideways and then beginning to trend down. And so as of really last Friday, GDP Now was estimating a 7.5% GDP growth for the second quarter. That number is, there's still data being compiled to generate that number, but it's been generally a downward trend in recent days. And so the market is kind of having a bit of this push and pull between growth expectations and inflation expectations. To a certain extent, you want to have the right cadence or balance between those. That's kind of the Goldilocks. Because if growth gets too high, then that's kind of an upward pressure on inflation and vice versa. So they tend to push and pull against one another. But best estimate right now is we're going to be somewhere in that range, kind of maybe perhaps ranging in the 7. I don't think it's going to be 11, but that's the high end of the predicted range, with GDP Now being a little bit lower than kind of the consensus estimate. As we move on to the next slide here, just a context here for the global economy. We've got for 2021 really a 5.6% expected global economy. These numbers are put out by the World Bank, so that's a bit of the estimate. And then the expectation is then that for 2020 things to moderate a little bit more. And then the graph here represents, you can see kind of the world as a whole broken out, and those are the points that we're plotting here. So the 2020 numbers haven't are still estimates being compiled. GDP for the entire world is a rather complex calculation, but looking at really the global economy shrank in the 3.5% range in 2020, really the expectation for 2021 is a 5.6% growth, and then beginning to taper off after that. So with that, just a quick snapshot here. The Fed funds rates. The Fed funds rate's been kind of a boring watch lately because things went in March of 2015 down to 0 to 25 basis points and have generally stayed there. And so the question really begins, what is the expectation going forward in terms of when we're going to start to see interest rates begin to normalize a little bit? But probably as important, if not more important than the Fed funds rate, is the Fed's bond purchase program. Currently at the tune of 120 billion a month. That's a lot. 80 billion in treasuries, 20 billion in mortgage-backed securities. So that's going to keep, that when you're throwing that kind of demand by the Fed at the market, that's significant to kind of artificially push interest rates down or keep them that way. So there's been some discussion there. If you look at various economists trying to Fed speak and read inside what the Fed is thinking, there's an expectation that there will be an announcement at some point in later this year that'll be the beginning of tapering. So it won't actually be the tapering itself, but it'll be an announcement that something begins with the tapering likely to begin in 2022. And what the tapering means is not necessarily going from 120 billion to 0 in terms of Fed purchases, but beginning a gradual reduction in Fed buying. So that's likely when that begins, there will be some natural supply demand impact and potentially put some further upward pressure on rates.
The conversation before the conversation.
Right.
Wow. It's not like the markets are addicted to stimulus at all.
Right. With that, the last chart here is, it's interesting how much these numbers tend to jump day to day based on the second quarter GDP, or the second quarter inflation number came out. It was a little higher than expected. And we saw a lot of the probability of Fed hikes go up. And then we saw in the last couple of days some of the variant news come out about putting downward pressure on growth, and we saw movement here. But what the market, when you take the futures market, forget economists. The futures market is basically putting their money where there's folks that are putting money where their mouth is from a Fed fund perspective. There's essentially a very little, almost zero probability of a Fed hike between now and year end. That's what the futures market is predicting. And when you get out to really call it a year from now into July of 2022, you're seeing about a 21% chance of a Fed hike. So it's increasing, but it's still considered low probability that there will be a Fed hike occurring really within the next year. But by the time you get out to the end of 2022, it's become more of an even money type of situation. So this is really the market in terms of those that participate in making bets on Fed funds rates, what the market expectation is, and we think that this is a fairly reasonable base case expectation. Of course, these things can move very, very quickly. And we know that has played out, and even in the last couple of weeks, we've seen these numbers jumping around quite a bit. But this is in essence, I think you have to get to 2023 before the market as a whole is saying there's a greater probability than not of a Fed fight or of a Fed funds increase.
And Matt, it's a great segue into some of the questions we've gotten around inflation, because the concern around inflation is, well, one, just on portfolios and assets; two, as a consumer, just a buyer of goods; but then three, does that force the hand of the Fed, and does the Fed have to take action as a result of inflation? So we'll take a bit of a detour here into inflation. It's one of the areas of the market that we've gotten a number of questions around, and just because inflation is kind of an omnipresent factor. It influences the prices of assets. It influences the economy. It influences the groceries you buy at the grocery store. And so, it's coming up in a lot of different ways. But frankly, it's also coming up because it's kind of new. Inflation, the change in price has been around forever, but it feels new because you really got to go back a while before you can talk about real inflation. So before we dive into what's driving recent inflation, maybe we can do a little bit of a history lesson. So this is dated going back to 1948 and the rolling 3-year CPI inflation. Now you can see that, the kind of the mountain chart in the middle. If you can't see this and it's an eye chart on your screen, that's the, late 1960s and then late 1970s. But it was really, you got to go back to the stagflation era of the 1970s when Paul Volcker was running the Fed and heroically broke the back of inflation to see a real material level of inflation. Yes, we had a spike in the 1990s. We had a spike in 2008. If anyone remembers that, that was when Goldman Sachs was calling for peak oil, and oil was at 150 and markets were falling, but they'd say, oil, it's going to 250. So, now, ironically, oil's been almost doing nothing but going down over the last decade. But you look over the long term and the averages, inflation is around 3.5%, 4%. Depending on how you cut the data. And recently, you got to look at this time period. We just haven't had much in the way of inflation. So anything that shows up above that 2-3%, the market kind of looks at it and says, whoa, this is new. This is different. What do I do with this? The last time I saw this, like the Walkman was a thing. So now the market's really focused on this number, the 5 and, call it a quarter, 5.32%. And that is current CPI. And there are a number of things that drive CPI. But rather than looking at just CPI, maybe we can take a step into kind of what the market is doing. Again, like as Matt said, people betting with their own capital. And this also ties to our outlook, which we'll get into in a moment on break-even rates. So one of the ways we as investors can look into market expectations for inflation is to look at break-even rates. We choose to do it on a 10-year inflation break-even. It's basically the difference between inflation-linked bonds and non-inflation-linked bonds. And the difference is showing us what the market expectation is for inflation. Now, the 10-year break-even, when we ran our capital market assumptions at the end of the year and rebalanced portfolios, it was at 1.8%. And it had been around that low level for a number of years, basically a fairly benign inflation. Now, when we reran that number as of June 30, it was 2.32. So a move up in inflation nonetheless, but 2.32 on a 10-year look forward is very different than 5.3 of current CPI. And so clearly there's a bit of a disagreement here. The market is betting through what we can see in break-evens that inflation will be transitory, it won't be permanent. But there's a lot of conversation on what could be or what could drive long-term inflation. And so if we bucket the two arguments, they kind of sit on two different bookends. And I want to be clear, these aren't necessarily our arguments. We'll give you our view, but we've just kind of prototypically wrapped the bookends of the conversation into these two boxes. So the short-term view around inflation it comes from a couple fold. One is you're literally mathematically looking at the base effect. So if you look at this graph and you say back to April, May, June of 2020, prices were depreciating because everyone was kind of locked in their house and wasn't buying a whole lot of goods. And so if inflation is anything, it's the difference between supply and demand. And if demand was down and supply was similar, if not identical, than it was the month before, then you have lower prices. So some of the short-term naysayers would say, this is just a mathematical short-term anomaly. It's a base effect and change. The others would say there's a change in inflation, or there's a short-term move in inflation from transitory issues. Those might be directly related to COVID, like supply chain items. They might be indirectly related, like the ship that was stuck in the Suez Canal. That could influence supply and constrict supply. There's also a number of things you can point to on a short-term basis when you look at U.S. ports and the consumption of goods. The need and demand for the U.S. trucking industry and the ability to get goods from ports to shelves to sell those items. Those kind of things tend to work themselves out over time. Now, on the flip side, you have the long-term sayers saying, hey, you just got a lot of things going on that are going to drive long-term inflation. Most of them would point to things like the amount of debt that's in the system, the amount of money that we've printed, the lack of, or the because of the pandemic, the shrinking of globalization. So all those things could influence long-term. Now, we want to take a bit of a dive, and this is kind of a nerdy topic, just into the idea of more money equals more inflation. This is the classic economic inflation principle of more dollars chasing the same or potentially the fewer goods, the more the price will rise. So that money, more money in the system, that's called M2, the money supply. And we can see how much money is in the system. But it's not just how much money is there, it's how much that money is being used. So if you can envision tagging your $5 bill that you spend at the grocery store and then seeing it loop through the economy, how many times is it going from your pocket to a grocer to back to your pocket to a grocer, et cetera. Now, on the top graph, we can see the dark blue chart. Money supply has gone way up. That's been from accommodative policies. It's been from action that is taken as a result of trying to stymie the effects of a pandemic. But the light blue line is the velocity of that money, how much that money is circulating through the system, and it has dropped. Now, it's not simply just having more money in the system, it's also having that money move around. Because if the money's not moving, you're not buying more things, if there's not more demand for things, the prices of goods and services aren't rising. So when you talk about kind of long-term and short-term inflation, our view is that most of the things that we're seeing in the market today are more transitory in nature, that they are not kind of permanent, secular, big inflation shaking items. However, nonetheless, it's very hard to predict inflation. The changes of inflation, the rate of inflation, we do not have enough hubris to say we have in the back, we have an inflation magic 8-ball that can tell us exactly where the markets are going. And so in the beginning of 2021, we said, we noted that there's a likelihood for rising inflation, whether it be transitory and or secular, doesn't have to be mutually exclusive. And we introduced more and kind of broad real assets in the portfolio to hedge against that potential risk. And so as we introduce those assets or increase those assets for some of our clients, you can see the reasons why we did so on the page. So the bottom graphic is a variety of different asset classes that react to markets differently depending on the context of the environment. And so if inflation is falling, which is the left set of bars, assets tend to act differently. If inflation is stable, which it is the majority of time, you see a fairly narrow, tight band. But then on the right, when inflation is rising, you do see some of these bars really shoot up. And those are those that are most sensitive to inflation. Things like commodities, natural resources, infrastructure, et cetera. So the exposure that we've been gaining through our outlook and through our allocations to these broader assets really help us hedge against that potential concern, regardless of it being transitory or secular. So with that, as we start to talk to transition into secular, we'll pass it back to Matt and we'll talk more about just kind of our capital market assumptions and portfolio positioning and some of our outlook.
Thanks, Brad. While you were talking, we got a great question that came in through the queue. It's said, do experts believe those items that increase the most, such as lumber and other home building components, will fall back to pre-COVID prices, or will prices remain higher from now on? This could obviously have tremendous long-term impact on the overall economy. I would say, you get two experts in a room, they're not necessarily going to agree. I can give you my opinion, which is, during the pandemic, there were obviously a lot of very unique factors that led to a spur in demand for home construction and kind of improvement items. And we've seen even within very, pretty broadly, particular pockets in particular, just a lot of real rabid demand coming into the housing market. And that's obviously increased a lot of the components to home building, the price. I think we're beginning to see a little end of that. I mean, it was a very speculative looking activity that we were seeing from a demand perspective, like incredible bidding wars and things like that you have to go back more than a decade to kind of see in the past. But that type of activity, my experience is that it doesn't continue forever. And I think we've even begin to see a little bit of softening in demand starting to come through. So, whether home kind of building components kind of return completely to pre-COVID levels, I can't speculate specifically on that, but I do think there will be a normalization and a return towards more normal as we go forward over the coming quarters.
Yeah, and there's so many moving components, right? Like if we date back to the Trump administration, right, a lot of North American lumber comes from Canada, and we're talking about cross-border tariffs. That could have a material influence on long-term prices. Now, if you talk about more demand for redoing your back patio, you're probably not going to do that every year. You might be motivated to do it because you're at home all the time during COVID, but that's not going to happen again in 2022 and 2023. And so those kind of transitory issues tend to normalize.
With that, I think we can dive into the capital market assumptions and portfolio positioning. Just as a quick reminder from the beginning of the year, I put up here a quote from our January 2021 capital markets update, and that was really we just go back in time about 6.5 months. This quote: "Real assets remain an important diversifier as the events of 2020 have likely planted some seeds for rising future inflation." So this elevated level of inflation that we're seeing relative to kind of norms over the last 5 or 10 years in particular is not something that is surprising to us. So from a portfolio positioning, the important thing is to know these, kind of implement these types of tweaks before things happen, because once they happen, it's too late. So you can see through the first half of the year anyway, the global stock market's up about 12% year to date through June 30th. Bonds are down about 1.5%. When we just look at some of the real asset categories here, whether it's real estate, commodities, natural resources, all of those up north of 20%. So, when you have that inflation beginning to break out, or that unanticipated inflation, that's when you expect real assets to shine, and they have. And with that, that's kind of a quick recap of the last 6 months. When we kind of look at longer term patterns, this was a piece that was put out by Schwab, I thought was pretty interesting, where they really looked at economic growth and inflation and looked at various regimes associated with it. So kind of the area that you really don't want to be from a market perspective is when inflation is rising and simultaneously economic growth is low. Stagflation is another term for that. And so you can see the bottom left, the red here, is that the equity markets do not like that combination. But when you get over here into the higher inflation side, it gets a little bit more complicated because on the far right side, as we're looking at the top quartile economic growth, really ranging from 4.8 to 13.4%. And when you look at those environments, the stock market actually does better when inflation is rising, which is a little bit unique in that regard in terms of what you might believe or what history or what you might remember about markets. So you get this scenario where you have a rapid economic growth coupled with inflation. That's actually not bad from a stock market historical perspective. And so I think that's just a useful backdrop we're looking at a period now where we're in the kind of the mid-range estimate is maybe 7.5% type of annualized growth. That's clearly above trend economic growth from an expectation perspective. So you have a little bit more wiggle room, arguably, to have a little bit more inflation than you typically would like to see without it being catastrophic for the stock market. And if we look at really the next slide here, just to summarize, if we did a mid-year capital market assumption update as of June 30th, we'd see a little bit of an increase in expected return for core fixed income from about 1.1 to 1.5%. That's really just a function of interest rates rising over time. From a global fixed income perspective, we'd see closer to 0.5%. So we've seen interest rates kind of trend up globally, not just in the United States. And then from an equity market perspective, we wouldn't, as Brad mentioned earlier, we've had a pretty nice run in prices, but we have had earnings kind of keeping pace, if not outpacing those increases. So really very modest change to the long-term outlook in terms of a 10-year return perspective. And then from an inflation perspective, we started the year really a break even of 1.8. We're in that 2.3% range. We actually peaked at right around 2.5% break even back in May and have kind of trended down a little bit since there. So, we do expect really an expectation of about 0.5% increase in inflation over the next 10 years. So, from a forward-looking perspective, we do think inflation will be trending higher than kind of longer term. By longer term, I mean the last 5, 10, 15 years than the trend that we've seen in those periods. But the question is, and I think in the front of a lot of people's minds is, are we headed for 1970s, early 1980s type of hyperinflation type of environment? We think that that's fairly low probability. We think there's certain things that are playing out that are creating supply chain disruptions as a result of kind of the lag in ability to supply and then demand returning to the marketplace post-COVID. So when we look at things going forward, while the equity markets on forecast from a nominal perspective haven't changed because inflation expectations are higher, it is a lower real return expectation. Fixed income, on the other hand, is kind of trended up with in terms of a forecast return in line with an inflation expectations. So, I think to Brad's point earlier too, broad financial asset class valuations continue to be elevated. That makes it, when you look out over a full holding period, the returns that we're expecting over the next 10 years are meaningfully lower than what we've experienced in the recent past. But there's, we think just given the backdrop, the economic recovery, that there's plenty of opportunity for things to continue to run here for the remainder of 2021 into 2022.
And I would say if this slide isn't enough for you, you're trying to jot down notes, don't worry about it. So we have our market outlook paper that was just released last Friday. That was authored by Chris Kashmar, our chief market strategist. So if you're looking for more just kind of on those forward-looking views or thoughts on inflation, capital market assumptions, et cetera, and you didn't pick up enough of what you wanted to get in from this webcast, you can obviously grab those there. So why don't we pause quickly, see if we have any questions from anyone else in the queue. And if not, or you don't feel like this is the right format to ask, you can always feel free to reach out to anyone at Fiducient and we can answer them for you. So I'll take a look in the queue here quickly. Doesn't look like we have anything in the queue. So again, I'll give the lawyers aren't here, but they wanted to make sure we put up the slide, but we also want to make sure to say thank you. So we appreciate everyone joining. If you have any questions, always feel free to reach out to a member of your Fiducient team. And thanks everyone. Have a great rest of the week.